Welcome back to The Explainer. Today we're diving into something totally counterintuitive about how our financial markets actually operate. We're going to unpack a really fascinating dynamic where the seeds of massive, catastrophic financial crises are actually sown exactly when everything looks perfectly safe.
So, that brings us to the core mystery we're looking at today. Is market stability actually dangerous? We're so culturally conditioned to believe that calm markets equal safe markets. When prices are steady, volatility is low, we all just kind of breathe a collective sigh of relief. But what if that exact stability is a trap? What if a lack of turbulence doesn't mean the storm is past, but instead means a much bigger one is currently brewing just out of sight?
To wrap our heads around this psychological and financial trap, we've got to turn to the legendary American economist Hyman Minsky. He famously coined this exact phrase, "Stability is destabilizing." Minsky observed that prolonged periods of low volatility actually act like fertilizer. They breed excess optimism, which then fuels the aggressive accumulation of hidden imbalances. Over time, players in the market just drop their guard, ignore the risks, and lever up. Section 1. The Illusion of Safety.
Let's examine how prolonged periods of calm actively trick the financial system into a completely false sense of security. Just look at the data right before the great financial crisis of 2007 and 2008. The VIX index, the market's primary fear gauge, it basically flatlined at incredibly low levels from 2003 all the way through 2007. At the same time, financial stress indicators from major central banks were completely flat. They totally failed to signal the onset of the crisis until it was literally underway. And yet, it was precisely during this eerily calm period that the lethal imbalances of the subprime mortgage crisis were actively accumulating. And this brings us to what's known as the red alert fallacy. The traditional view relies on watching for a massive spike in volatility to warn us of danger. But relying on perceived risk, which might be low at the moment, blinds us to the hidden risks building up beneath the surface. As the research points out, waiting for a volatility spike to take action is essentially like waiting for your house to catch on fire before you decide to go out and buy a fire extinguisher. And hoping for same-day delivery, right? By the time the alarm bells are actually ringing, it's already way too late.
Moving on to Section 2. The Volatility Paradox. Minsky's idea that stability breeds instability? It wasn't just a philosophical hunch, it's an empirical historical fact that has been rigorously tested. Take a look at this staggering number, 211. That represents the years of historical data analyzed in a massive study by the London School of Economics. Researchers looked at data across 60 different countries, spanning over 2 centuries, just to see if they could validate this exact volatility paradox. They wanted to know, do unusual levels of calm actually predict subsequent financial crises?
Well, the results were absolutely definitive. The data explicitly shows that prolonged periods of unusually low volatility are a highly reliable early warning indicator for banking crises. Specifically, if volatility lies just 1% below its long-term trend for a period of 5 years, the likelihood that this environment will culminate in a financial crisis increases by 1.0%. The lack of risk in the market isn't a sign of permanent safety, it's literally a measurable countdown to instability.
Section 3. Fueling the Fire. So how exactly does low volatility push otherwise rational people and massive institutions to make highly dangerous decisions? This sequence maps out what's called the leverage cycle. It starts with low volatility. Because prices aren't swinging wildly, lenders feel deeply secure. This security encourages them to demand less collateral, which allows borrowers to take on massive amounts of debt. All this borrowed money floods the market, artificially bubbling up asset prices. But because the system is now hyper-leveraged, it becomes incredibly fragile. It just takes one tiny shock to trigger margin calls, forcing everyone to sell at once, which dominoes straight into a crash. So the crucial point here is how modern institutions actually manage risk. Banks use mathematical models where volatility is a primary input. When volatility drops, their models tell them their portfolios are suddenly much safer. It's a bit like assuming the highway is totally empty just because your speedometer is broken. This acts as a green light, allowing them to pro-cyclically increase their balance sheet leverage and reallocate capital from safe assets into highly risky ones just to chase yield. During these booms, the quality of loans continuously declines, but the overwhelming market optimism completely masks this degradation.
All right, Section 4. The Ouroboros of risk. To see exactly how this paradox plays out in today's incredibly sophisticated markets, we have to look at the Ouroboros, the ancient symbol of a snake devouring its own tail. It's a really visceral metaphor for what analysts call the modern bear market in fear. The investment ecosystem has essentially self-organized into one giant, self-cannibalizing feedback loop.
In the absence of traditional value, volatility itself has become an input for risk-taking and actually the primary source of excess returns.
If we look a bit closer at the labels on the snake, we see the true alchemy of risk. We've got central bank stimulus, negative rates, and quantitative easing actively suppressing natural market turbulence. This artificially lower volatility feeds directly into passive indexing, risk parity strategies, and a massive multi-trillion-dollar short volatility trade. So lower volatility reinforces even lower volatility in this crazy self-perpetuating cycle, pushing variance towards zero. Now, it looks like a magical formula to print money, but it is actually building the potential for a violent, hyper-crash feedback loop when conditions finally reverse.
One of the absolutely most glaring examples of this self-cannibalization is corporate share buybacks. Since 2009, U.S. companies have spent over $3.8 trillion on what is effectively a giant leveraged short volatility position. Instead of taking capital and investing it in real economic growth, corporate managers act like arsonists. They issue massive amounts of cheap debt to buy back their own stock. This artificially boosts their earnings per share and manufactures stock market gains, all while massively increasing the underlying hidden risk right there on their balance sheets.
Section 5. The Minsky Moment.
So, we finally reached the inevitable climax of this debt-leveraged house of cards. A Minsky moment is the exact threshold where the illusion finally shatters. It's defined as a sudden, major collapse of asset values that abruptly ends the growth phase of a credit cycle. Basically, it's the moment when reality sets in for over-leveraged investors, and that long period of steady prosperity violently gives way to panic. Let's walk through how this builds into a true catastrophe, because it doesn't take a massive economic disaster to start the chain reaction. It begins with just a modest decline in asset prices. Suddenly, the cash generated by those assets is no longer enough to pay off the massive debts used to acquire them. Lenders panic, they call in their loans. This forces leveraged investors to aggressively sell off assets just to cover their debts. In severe situations, buyers completely disappear, fearing further declines. Market liquidity entirely vanishes, resulting in a precipitous, terrifying collapse in prices. But it's really vital to remember that the transition into a Minsky moment isn't always a slow, quiet rollover. Market tops can be incredibly chaotic. Just look at the late 1990s dot-com bubble. Between 1997 and 1999, the S&P 500 rose nearly 100%, a massive melt-up in returns. But it happened alongside massive spikes in volatility, which were triggered by the Asian and Russian financial crises. High volatility and high returns can and definitely do coincide in the final, frenzied phases of a speculative market right before the ultimate crash. So, as we wrap up this explainer, I really want to leave you with a provocative thought to chew on. When you look at today's financial news, when you see periods of calm, low interest rates, and soaring asset prices, ask yourself, are we actually in a period of true fundamental stability? Or has the volatility paradox already set the trap and we're simply waiting for the inevitable arrival of the next Minsky moment? Thanks so much for joining me today. Keep asking the hard questions, and I'll catch you in the next explainer.